Hello viewers, this video involves a lot of researched data points that can help you create a view about the market scenario today and make informed decisions. In this video, whatever we are sharing is a personal view backed by research and in any way does not mean or should be constituted as an investment advice. Use professional wealth manager support to make your own investment decisions. Let's get started. Recently, RBI came up with their monetary policy and they have decided to maintain the repo rate at 5.5% and increased our GDP growth forecast from 6.5% to 6.8%. SDF was maintained at 5.25. MSF was also maintained at 5.75. Bank rate has been maintained at 5.75. Reverse repo rate has been maintained at 3.25. Cash reserve ratio has been maintained at 3.75 and SLR has been maintained at 18%. Moderate inflation and good monsoon have been the key factors why RBI has increased our GDP growth forecast, and a strong support towards growth by RBI in the coming year is taken positively by the markets. In this global landscape, India is a part, and let's look at how India has done as compared to its global peers. Central banks across the countries have had relatively easing policy framework, and even though monetary policy is easing, the market performances have been very divergent. Korea, for example, is up by 55%, driven by corporate governance reforms. Europe, the valuations remain low and hence returns have been decent. The S&P 500 has given a return of 17.7% in the YTD 25 period, and it is a good performance by USA. However, USA has a very high fiscal deficit amounting to around $38 trillion as on today, and dollar has appreciated by 12%, which is highest in the last 5 decades. This results generally in a capital outflow from USA to other global markets. Market performance in USA has been relatively narrow, led by 7 to 8 good companies in the technology space, and that is why a lot of people are worried that the performance of American markets is not wide based. Small and mid cap has underperformed, and there is increasing cases of bankruptcies and furloughs by corporate America. All this said and done, their GDP has rebounded from which was at minus 0.5% to a positive 3.3% in Q2 25. This GDP growth is led by reduction in imports, which is a positive from the US tariff point of view, and private investments are generally led by AI companies. So real GDP growth being at 3.3%, reduction in imports have contributed positively by around 5%. Private investments at a large scale level is still one of the reasons why it is lagging behind at minus 2.7%, and personal consumption expenditure by the public is growing at 1.07%. If you look at the capital expenditure from the big 7 tech companies in the country, it is almost equal to the remaining 493 companies in the S&P 500, and that in terms of a shift in, or the quantum of capital expenditure that is coming from a broader base is very less. To compensate from the corporate side, US government has been increasing spending. These levels are close to World War II, where US government is spending around 44% of its GDP to support economic growth of the country and support real GDP growth. That being said, fiscal deficit is at an all-time high at $38 trillion, and debt continues to remain a big problem for the US economy. When we look at the US tariff policies, it applies to both goods and services. While they are doing fairly well on the goods part, when we look at goods and services combined, their deficits have increased. If we were to compare the first 7 months of 2024 and first 7 months of 2025, the deficits that US is having from both goods and services has only increased from a negative $500 billion to a negative of $650 billion, which is worrying for the country. At the end of the day, the tariff in the long run is going to be borne by the consumer of USA or the citizens of America, and that itself will lead to inflationary pressures on the economy. While initially half of the cost will be borne by the American citizens, in the long term, 70% of the tariff hikes that have been imposed as duties or tariffs to countries that are exporting to USA will be borne by the American citizens. Today, US has higher number of unemployed citizens as there are job openings, and slowly and steadily the unemployment rates and the job opening rates are narrowing towards each other. If job opening starts to fall from here, it can be an early stress signal for the US economy. The dollar, like I said, has depreciated by more than 10% in 25, and this is by far the highest as compared to its depreciation in the last 5 decades. Historically, whenever dollar has depreciated at that rate, money has moved out of USA to other economies of the world. Clearly, large 7 companies of America are gaining momentum, but the small and mid-cap portion of the market is not performing as well as its peers in the mega 7-8 companies. So the performance is not broad-based, it's limited to a set of 5 to 7 companies. On the other hand, if we were to look at India, India's growth has made the headlines by growing at 7.8% of GDP in the Q1 of 26 financial year. This by far beats its estimate and is a big positive of structural growth supporting the Indian economy. Every quarter on quarter, India has done better. Last year in the same quarter, we were at 6.4% growth. India has a rising role in global economics. Our contribution to GDP growth of the world and our net contribution to GDP as a percentage is increasing every 10 years. In the 2000s, we contributed 6.6% to global GDP growth and 3.6% to real GDP. Today, we are contributing 15.8% to GDP growth and 7.8% contribution is as a percentage to the real GDP. This is estimated to become 19.2% contribution to GDP growth and 9.2%. This is a great fact. Around 10% of gross domestic value of goods that is produced by the world will be produced in India, and this gives everybody a lot of confidence that our economy is structurally ready. This is also recognized by rating agencies globally. Our rating has been improved after 18 years by rating agencies globally, and this is a big testament to fiscal prudence that government of India has shown. All said and done, Trump tariffs have been hit hard on us. We are being penalized by additional 25% for importing Russian oil, has hit us hard. We were earlier being imposed 25% tariff, but on top of that, additional 25% tariff, it makes India the most taxed country in Asia. While Trump tariffs are a big issue, our Indian government has responded pretty well to the situation. There have been structural reforms in GST that will be taken very positively for decades to come. The biggest ask is to turn Swadeshi. We see a lot of tech companies in India taking steps to make an indigenous solution to all big tech companies that are present globally, and India is responding to become Atmanirbhar in technology as well. This year of 25 has been a year of reforms. Started with direct taxation. India has received 1 lakh crore stimulus just by revision of direct taxes, where income up to 12 lakh rupees is tax free. The second reform came in the form of GST rate cuts, which will add around 50,000 crores in the hands of Indian citizens by March 26 and another 1 lakh in the year FY27. There has been an interest rate cut, which also leads to 1.2 lakh crores in the hands of Indian citizens. And in January, there is a 8th pay commission that will give 2.4 lakh crore rupees in the hands of government employees. And online gaming curbs are estimated to give around 10,000 to 12,000 crore rupees back in the hands of Indian citizens. These structural reforms far outweigh the tariff that has been imposed on India. As we saw, a lot of impact of tariffs will be borne by the US consumer. And these reforms, once done, are going to be structural backbone for India over the next decade. So our benefits far outweigh our deficits. Apart from that, India is still negotiating with USA, and if we are able to crack a deal which leaves or which removes the additional 25% tariff that India has to pay because of importing Russian crude, we are going to be far ahead of the curve than anybody else in Asia. To deep dive a little about GST reforms, the impact has already started to see. While the GST reforms were coming to implement on 22nd September, in the last 20 days or so, we have seen the automobile sales has increased significantly. There was recently an article where Mercedes aims to have sold a new Mercedes every 6 minutes during the festival season. When we look at consumption from an urban and rural standpoint, there had been a cyclicity between urban and rural. When rural was performing, urban was not performing, and when urban demand picked up, rural had been lagging behind. A similar trend had been seen in 25, where even before GST reforms, rural demand was already in place, and now urban has started to catch up. So this is one of the ways in which probably both urban and rural demand will now go up, and it is a huge positive. Despite these reforms, Indian capital market has underperformed by 8% from its previous one-year top. Germany has given 30% return, South Korea has given 23% return, China has given 23% return, USA has given 15% return, UK has given 13% return, France has given 7% return. So across global economies, India has been the only economy that has underperformed. In the last 25 years, it is very rare for India to have a negative return in a one-year calendar year period. This has happened 4 times in the last 25 years, and every year was followed by a massive bull run which lasted from 1 year to 3 year period. The data is in front of you. In 60% of cases, whenever Nifty has delivered a negative return, it has bounced back to give more than 15% return in 1 to 3 year period, and a 90% probability that Nifty will give more than 10% return after giving a negative 1 year return. Markets are a slave to its earnings, and India in PAT to GDP ratio is well above its average of 5.4%, despite giving single digit return or single digit PAT in Nifty 50 in the last 1 year. We have maintained our long-term average of 5.4. The losses have reduced significantly and are converging to zero in the Nifty 50 companies. From a valuation standpoint, Nifty stands very close to its 10-year valuations or PE. Mid-cap is at 24.9 as against 22.9 for the 10-year period, and small caps are at a significant premium to 10-year averages. In this quarter earnings, revenue is expected to grow at 7%, while EBITDA is expected to be at 8%. A lot of investments have moved from India to China, and today India is exactly like a mirror image to China in terms of FII flows. So if India flows are reducing, a lot of FIIs are going and investing that same money in China, because China has been a fairly valued market or has underperformed India in the last few years. As and when India earnings start coming up, we expect FIIs to come back, and this is quite evident if you look at recent market data. FIIs have been underweight on India, and their portfolios today hold only 16% of India. This is a decadal low, and it is only one's guess as to how much they can continue to sell from here on. In the same period, retail investors through mutual funds have made significant increases in terms of capital flows. This increase has also increased holding shares of DIIs in the capital markets. Is this the beginning of Atmanirbhar capital markets, where India is also owned by Indians, is what we have to see. Over the last 3 years, FIIs have continued to sell India every month. The selling is far ahead of its buying, and this has also led to little bit of fall in the capital markets. As on September 25, DIIs bought $7.5 billion of equities in the capital markets. Another trigger, which is a very important trigger, is the ratio of MSCI emerging market to S&P 500 index. Relative share of MSCI to S&P 500 is at an all-time low. This was last seen in March of 1999, and this also indicates that this kind of performance of US market cannot continue for long relative to MSCI emerging markets. Today, there are certain reasons why emerging markets are way attractive from the valuation standpoint as compared to any other market. First being US dollar depreciation has been highest in the last 5 decades in 25 to the tune of 10%. US fiscal situation is not great. They have a debt of $38 trillion. And to top it up, they are having their whimsical policy framework. Normally, it has been seen that emerging markets and US markets follow the cycle. The last 15 years has seen US outperform emerging markets, and how long it can continue is anyone's guess. Today, there is an extreme divergence between the performance of emerging markets versus US, and if nothing else, investors will book profit from US markets and invest elsewhere. India's performance relative to emerging markets has also been the far worst. We are at a decadal low in our performance relative to the emerging markets. And if a FII were to evaluate based on valuation or relative valuation of emerging market, India would appear fairly valued. Please share, comment, subscribe to our channel. It is also a motivation for us to continue to make new videos and add value in the lives of our viewers. Jai Hind.